and welcome to Fidelity Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lucas Tepulbe and I'm Fidelity's global cross-asset specialist. And today I'm pleased to be joined by Casey McLean, portfolio manager for our Australian High Conviction Fund and ETF, and also has a vast amount of experience in Asian markets as well. So very pleased to have Casey. Welcome.
Thanks very much, Lucas. Great to be here.
So let's kick off with some of the big ticket items. So one of the things that markets have been watching very closely in recent times is China, and specifically a big amount of stimulus that was announced over the last couple of weeks. Biggest stimulus, I think, since 2015. Now, obviously that has ramifications for China, but it also has broader ramifications for the Australian market. So maybe if we can go through what are some of the key points of the stimulus, and I'd love to explore what does it mean for Aussie markets, given that China is our biggest trading partner.
Sure. Well, I think you're right, Lucas. It is the biggest policy announcement since 2015. It's a really major change in tone that we've seen from Chinese regulators over the last 2-3 years since they reopened post-COVID. They've put in numerous measures into the economy, but I see them more as support measures. Mm-hmm. This round of announcements is clearly stimulus rather than support. And it was really big change in tone. It started with what is effectively an interest rate cut. The mechanism in China is a little bit more complicated than Australia, but there was various measures to ensure that existing mortgage holders get lower rates, new mortgage holders get lower rates, and banks have the capital to do that by lowering their reserve requirements. And so that really is dealing with the supply side of the economy, the liquidity. Mm-hmm. They're injecting liquidity into the economy, which is great. But you also need the demand side to come to the party. Mm-hmm. And just the very next day after the interest rate announcements, they had a Politburo meeting, which is a quarterly event, but the September one doesn't usually deal with economic issues. This time it did, mm-hmm. and very meaningfully, they came out at 1 p.m. local time and gave an announcement, which was the we're going to do anything moment. Mm-hmm. They said they're going to make counter-cyclical adjustments, have large fiscal spending, issue ultra-long bonds, put in measures to stabilise the property market and also help support capital markets, the equity markets as mm-hmm. well. So we're yet to see the numbers behind this. They will come in time. China's a holiday period during October mm-hmm. as well, but likely sooner rather than later we're going to see numbers around this. And hopefully that's big enough to really support the demand side mm-hmm. of the economy. But even before they went on holidays, you did see further measures in the property market. Some of the tier one cities relaxed or even totally eliminated, in the case of Guangzhou, all home purchase restrictions as well. Yeah, right. And tier one cities are important in the property market. It generally leads all cities throughout the country mm-hmm. as well. So I think it's we're going to look back, and I think it will be a pivotal market, pivotal point. Yeah, absolutely.
And I think we saw Chinese equities soar on the back of the stimulus package, but if we look at it from a Aussie equity perspective, it has actually had ramifications for the Aussie equity market. What have you observed from an Aussie equity perspective on the back of that stimulus announcement?
Yeah, the most obvious impact has been a big rotation. The rotation has been into resources, which is the traditional play in Australia on Chinese growth. Not unexpected. And the funding source has been the banks. Mm-hmm. We've seen selling in the banks. Consistent selling, actually, even when resources have had sort of pullbacks, you've still seen that selling mm-hmm. continue in the banks as well. Mm-hmm. And within the resources segment, it is backed by the fundamentals as well. Mm-hmm. Commodity prices have gone up since these announcements. It remains to be seen whether this is sort of trader driven or mm-hmm. it is supply demand, and it's probably the former. It's a bit too early to see demand impacts yet, but I think generally commodities are focused on the sort of present rather than forward looking. So it's a good sign that fundamentals are improving and the outlook has improved.
Yeah, no, it definitely has been interesting because certainly a lot of people have been talking about the banks for some time and valuations and so forth. So it's interesting to see that rotation. One of the stocks that we spoke about in a little bit of detail was Bega, which I thought was interesting and I guess it is related partly to this sort of Chinese theme as well. Talk to me about that, because I thought it was an interesting sort of insight in terms of some of the drivers of a company like that.
Yeah, it is an interesting company. And speaking with our analyst, Cheng, in Sydney, who covers the stock, he's become more positive because the milk prices in Australia have declined. If you look back just recently, Australian milk prices have been at a premium to global prices. And that's really because the milk supply has been steadily ratcheting down over the years, and there's been an excess of downstream bulk milk processing capacity, while at the same time, global prices have been very low. So you've seen Australian prices higher than global. It's meant imports have come into Australia and affected the market that way. But more recently, a couple of large players in the milk processing industry, the downstream, they've exited. So now there's a bit of an excess of supply on upstream raw milk, and prices have come down a lot. And that helps Bega in terms of their bulk milk processing business. But, when I was up in Hong Kong just a few weeks ago and speaking to our analyst there, Teddy, who is looking at the Chinese dairy companies, he's seeing, quite a different picture that, the milk prices in China are basically at record lows. There is a demand element to that as well, but it's really supply driven. And from his visits out to farms in Mongolia and the like, he has seen that the dairy companies are taking action. They're rationalising their herd, which should increase Chinese prices and perhaps even flow through to global prices. So if this happens, if this eventuates, you could see a case where now Australian prices down, global prices rising, global being higher than Australia, and it's a pretty good environment for Bega's bulk milk processing capabilities.
Yeah, I mean, it's a great sort of test case for, an Aussie company, but having that global analyst reach and interacting with those analysts, how important that is to get the full picture, I guess, on a company like Bega. If we move to Australia, and again, sort of the bigger picture, I mean, I guess the number one topic has been rates and the RBA as to will they cut rates, when will they cut rates, all the rest of it. We saw that in the recent announcement, they kept rates on hold, obviously pointing to continued sort of sticky inflation, continued strength in the labour market. I guess, what are you sort of seeing from a company perspective? I mean, are companies from a bottom-up perspective, are they cautious in terms of where rates are at? Is it business as usual? What implications do things like rates have on some of the companies that you're talking to?
Well, I think generally speaking, companies' balance sheets are in pretty good shape. They've been relatively conservative in terms of how much leverage they've been able to take on, and were helped out by some governments of handouts during the COVID period as well. There are some more leveraged sectors in the market, naturally leveraged sectors like property REITs, who do run high gearing levels throughout the cycle. And we have seen those companies start to outperform the market as well. And there are a scattering of companies, I think, who do have over leveraged balance sheets. They're somewhat skeptical of how bad this cycle can be, or how long the down cycle can last. And you have seen them raise equity to sort of shore up their balance sheets. Fletcher Building is case in point. They're more leveraged to the New Zealand economy, which is in a worse shape than Australia. But generally, they're in the minority, and I think company balance sheets look pretty good now. But I think when we think about the impact of the rate cycle when Australia cuts, and US has obviously already entered into that rate cutting cycle, but the difference to me with this cycle is really the starting point where we're at. If you look at both Australia and the US, we're actually at the highest valuation ever prior to a rate cutting cycle. And that's probably because we're not in a recession currently, as we usually are when we're entering into a rate cutting cycle. And, it's also show up in unemployment. It's pretty rare to be cutting interest rates so potentially, an aggressive cycle like the US is potentially doing when you're close to full employment levels as well. Yeah. So stepping back, you have to think, well, is this going to be the normal sector rotation that you see in an interest rate cutting environment? I don't think so. I think this time could be different to normal recessionary interest rate cutting cycles.
Yeah. So, I mean, if I take from that, I guess the main thing is that a lot of the companies you're looking at are pretty resilient. Balance sheets are looking pretty good. And I guess in terms of, recession risk, there, but probably low risk. That would be my sort of key takeout.
Yeah, I think that's right. I think, we've been of the view that a recession, at least in Australia, is unlikely throughout this whole period. And I think although Australia hasn't started cutting rates yet, the US has, and Australia will at some point.
Yeah.
That reduces the risk of the recession further. But what's clear is growth is slowing and inflation is reasonably sticky, but so sort of the risk of a hard landing continues to sort of abate.
Yeah. Probably the other area which is quite interesting is the construct of the Aussie market, because a lot of the market has been commentating for some time around the US market and the concentration of the market, particularly around those Magnificent Seven stocks, those sort of well-known tech AI-related companies. But one of the things you pointed out, which I thought was quite interesting, that if we look at the Aussie market, roughly 70% of stocks, of the drivers of the market really can be attributed to 6 stocks. So you could argue Australia almost has its own sort of little Magnificent Six, so to speak. Talk us through that, because I didn't actually appreciate how concentrated our market has been in terms of performance.
No, that's right. I guess, Australia's always been a pretty concentrated market with the big 4 banks and 2 miners. But you're right. I think it's year to date up until sort of mid-September, around about 70% of total market returns were driven by just 6 companies. It was the 4 major banks plus Wesfarmers and Goodman.
Right.
And another way to look at this is if you compare the market cap weighted index, the ASX 200 that you see quoted on the news, versus an equal weighted index, the market cap is outperformed by about 5% year to date as well. So we do go through periods where the major companies, the big companies drive returns, but usually you do see a rotation back into other areas of the market as well. And I think that's a likely outcome as the sort of economic situation, the rate environment does change as well.
Yeah.
Because I look at those 6 companies that driven those returns, and I think it's hard to justify the performance of the banks on fundamentals. Earnings are flat to modestly up or down, and that's the likely path for the next couple of years. But you've seen a significant re-rating. Pretty much every bank is trading at record multiples in absolute terms and record multiples relative to the rest of the market. Whereas, if I was to contrast with Wesfarmers and Goodman, I think their performance, although some of it is from re-rating, a lot of it is driven by the fundamental improvement that you've seen in those businesses. So Wesfarmers is in a pretty good environment at the moment. Their Kmart business is benefiting from trading down. The Anko brand that they've developed over the years has been enormously successful and a big part of that success as well. And Bunnings obviously just continues to grow, the sort of behemoth in that sector. And then Goodman, they've in the 2 best asset classes within property in logistics, which is leveraged to e-commerce and the growth of that, and data centers is a sort of new entry. So I see them fundamentally driven, whereas the banks have potential to see rotation out of them into other areas of the market.
Yeah. So you run a very concentrated, punchy portfolio. So when you think about, taking positions in stocks, you've got to have a high level of, I guess, conviction in those stocks because you are running a concentrated portfolio. Outside of those sort of 6 stocks, what are other areas that you're seeing opportunities in at the moment?
Well, I think, the first one, which we talked about, is really that materials resource sector, that rotation, particularly if the Chinese policies come through. I think that potentially has legs. But you need to be a bit selective, I think, within commodities. There are some that are oversupplied, potentially getting worse, like lithium, whereas others that have tight markets and potentially tightening as well over the years to come as well. I think, another area that's attractive is the structural growth, the quality growth companies in the market, mainly centered around the sort of tech and some in the retail segments of the market. You do need to pay up for that growth, but they are structural growth companies in some cases and can probably continue to grow strongly even as the macro weakens as well. The growth slows down in the economy. So that's another one. And I think probably the final one that does look attractive from a medium term point of view is more the industrial, cyclical type businesses. You've seen whenever there's improvements in the PMI and global macro, these companies in Australia do very well. So there is a cycle coming, an upcycle coming on the other side where growth will accelerate. And I think these companies, which are generally smaller cap by nature, will perform pretty well over the medium term as well.
Excellent. Well, Casey, thank you very much for your time, and I appreciate your insights.
Great. Thanks very much, Lucas.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform. Or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.